They want you to believe that the silver dream is over. If you've been watching the charts this week, you've seen the headlines, you've seen the red candles. You've seen the retail investors who bought the top at $111 an ounce throwing in the towel. But today, April 10th, 2026, we aren't looking at a collapse. We are looking at a tactical reset in the greatest financial war of our lifetime. Think back to just 90 days ago. The world watched in absolute shock as silver exploded from $71.59 to $111 in a matter of weeks. It was a vertical move that caught every major bank on Wall Street off guard. But that parabolic surge wasn't just hype. It was the first time the global market realized that the structural deficit we've been warning about for 6 years was finally breaking the paper exchanges. And then came the hammer, a violent 35% drawdown that took the price all the way back to the $73 support floor. To the uneducated, it looked like a crash. To the elites in the London bullion market and the Shanghai Gold Exchange, it was the great siphon. While the West was selling their paper contracts in a panic, the East was opening the floodgates. As of this very moment, silver is heading for its third consecutive weekly gain. The price is currently fighting a fierce battle at the $76 resistance level. The ceasefire gains from the Middle East have been completely erased by the strikes on Lebanon. The safe haven premium is back with a vengeance, and the industrial demand from China is reaching a boiling point. In this breaking news update, we are peeling back the layers of the most manipulated market on Earth. We're going to look at the secret export restrictions Beijing implemented on January 1st to starve American industry. We're going to analyze the strikes in Lebanon and why the Islamabad negotiations, potentially involving U.S. leadership, are the X factor for the next $10 move. And most importantly, we are going to show you why the 111 to 73 correction was the final bear trap before a supercycle that could take silver toward the $300 mark. The Lebanon powder keg and the U.S. consumer, the world changed yesterday, April 9th. For weeks, the narrative from Washington was de-escalation. We were told a ceasefire was imminent. The markets, being forward-looking, had priced in peace. This is why silver softened toward the $73 level last week. But then the strikes on Lebanon hit, and the reports from Investing Live confirmed that this wasn't just a skirmish. It was a direct hit to the Middle East energy corridor. According to the latest reports from the Asian Development Bank, these strikes have triggered a massive reallocation of capital. When missiles fly in the Levant, the smart money doesn't wait for the evening news. We've seen Brent crude jumping toward $110 a barrel this morning. For the average American, this means higher prices at the pump by next Tuesday. But for the silver investor, it means something much more profound. In the world of commodities, oil is the cost of production. You cannot mine silver in Idaho or Nevada, refine it, or transport it across the ocean without burning diesel. As energy prices spike, the marginal cost to produce an ounce of silver is being forced upward, creating a new permanent price floor. But there is a deeper psychological shift happening. The Federal Reserve's March meeting minutes showed a wait-and-see approach, but the sudden escalation in Lebanon has made a soft landing look like a fantasy. As traders await the Consumer Price Index report later today, the focus is shifting back to hard assets. If the Islamabad talks fail to secure a path to stability, the peace discount will vanish. We are already seeing silver rise towards $76 on Friday morning as easing rate hike bets provide a tailwind. The market is realizing that even if the Fed wants to keep rates high to fight oil-driven inflation, the geopolitical risk of a wider regional war is too great to ignore. China's economic war on Silicon Valley, while Western headlines focus on Lebanon, the real story, the one that will actually dictate the price of silver for the next decade, is happening in Shenzhen and Shanghai. The data from the Shanghai metals market for the first quarter of 2026 is nothing short of historic. In February alone, China's silver ingot imports surged to 206 metric tons. That is a 5,910% increase year on year. This isn't just a statistic, it is a declaration of economic war against the United States. Why is China hoarding silver at this magnitude? Beijing has realized that silver is the Achilles heel of the American tech sector. On January 1st, they imposed strict new export restrictions, limiting silver outflows to only 44 state-sanctioned entities. This effectively cut off the discounted silver that American manufacturers like Tesla, Apple, and Raytheon relied on. Simultaneously, the import arbitrage window opened wide. Domestic silver prices in China were trading at a premium of over 3,000 yuan per kilogram above the London fix. This created a giant vacuum, pulling physical silver out of the New York COMEX and London LBMA vaults at a rate of millions of ounces per week. China's playing the long game. They are draining the West's physical inventory while the price is temporarily suppressed by paper traders on Wall Street who don't even own the metal they are selling. The BRICS threat and the death of the petrodollar. We cannot talk about silver in 2026 without talking about the BRICS nations. Brazil, Russia, India, China, and South Africa, now joined by Saudi Arabia and others, are actively building an alternative to the US dollar, and the foundation of that alternative isn't a digital currency, it is hard assets. New data released on April 8th shows that India has just shattered all previous silver import records. In the first 3 months of 2026, India imported a staggering 4,000 metric tons of silver. This is nearly half of their entire annual consumption in just 90 days. The Indian middle class is doing what the American middle class used to do. They are protecting their wealth. With gold prices crossing $3,000 an ounce, silver has become the common man's gold. In Mumbai and Delhi, local jewelers are reporting total sellouts of investment-grade bars. When you combine the hoarding in China with the record-breaking consumption in India, you are looking at more than 60% of global annual production being swallowed by just 2 nations. The United States is being left out in the cold. If you aren't holding physical metal today, you are essentially betting that the BRICS nations will fail in their mission to dethrone the dollar. That is a dangerous bet to make. Tesla, Samsung, and the defense shortage. Let's talk about why silver is the next generation metal for American dominance. We were told that manufacturers would find a way to remove silver from technology, but the biggest tech news of 2026 has just proved the skeptics wrong. Samsung has officially announced the mass production of its solid-state battery for high-end electric vehicles. This is a game changer. These batteries use a silver carbon anode. Each one of these next-generation battery packs requires roughly 5 to 10 grams of silver. While that sounds small, when you multiply it by the millions of EVs planned for the 2027 model year by Tesla and Ford, you are looking at an entirely new industrial demand sector that didn't exist 2 years ago. But it's not just about cars, it's about national defense. Every Tomahawk missile, every F-35 fighter jet, and every nuclear submarine requires silver for its advanced circuitry and guidance systems. As the conflict in Lebanon escalates, the U.S. Department of Defense is quietly realizing they have a supply chain problem. Silver was only added to the Strategic Critical Minerals list in late 2025. We are decades behind in securing our domestic supply. The U.S. Mint and the retail shortage. If you want to know how tight the market really is, look at the U.S. Mint. In 2025, the Mint struggled to source enough blanks to produce American Silver Eagles. By April of 2026, the authorized purchaser list is reporting delays of up to 8 weeks. The premiums for physical silver in the United States are telling the true story. While the COMEX paper price sits at $76, try walking into a local coin shop in Ohio or Texas. You aren't getting a Silver Eagle for $76. You are paying $95, maybe $100. This reality gap is a clear signal that the paper price is a lie. Wall Street banks use paper contracts to dump silver and keep the price low, which allows them to cover their short positions. But you cannot build a Patriot missile or a Samsung battery with a paper contract. You need the physical atoms. And those atoms are disappearing into private vaults across America and sovereign vaults across Asia. The 1933 parallel. Could it happen again? In 1933, Franklin D. Roosevelt issued Executive Order 6102, criminalizing the possession of gold by U.S. citizens. Many silver investors are asking the same question today. As the dollar collapses and silver hits $111, will the government come for your metal? The history of silver is a history of confiscation and revaluation. In 1934, the Silver Purchase Act allowed the government to nationalize silver stocks. But there is a key difference in 2026. Silver is now an industrial necessity. Nationalizing silver today wouldn't just be about money. It would be about shutting down the entire American tech industry. The correction from 111 to 73 was a psychological operation. The SAR. It was designed to make you think silver is too volatile, too risky, and not worth holding. They want you to stay in the dollar. They want you to keep your wealth in a banking system that is currently being bypassed by the rest of the world. The technical analysis, the $76 battleground. Let's look at the charts for the American investor. The drop to $73 was the washout, and that's in the 10 cents into March de Preten. It was designed to trigger stop losses and clear the weak hands out of the system. But here's the difference. The hunts are now sovereign nations. You cannot change the rules on India or China like the COMEX did to the Hunt brothers in 1980. As we trade at $76 today, the charts are showing a massive bull flag pattern on the weekly time frame. The relative strength index has reset from extreme overbought levels to a neutral zone, providing the energy for the next move higher. The moving averages, specifically the 50-day and 200-day, are beginning to curl upward in a golden cross formation that technical traders look for as a confirmation of a secular bull market. The next leg up won't just retest 111, it will likely blast through it as the physical squeeze becomes undeniable. The mining disconnect. Why production is in terminal decline. One of the biggest myths is that American miners will simply dig more silver. But the data from the first quarter of 2026 tells a terrifying story. Silver production in the Americas is falling. 80% of silver is a byproduct of copper, lead, and zinc mining. Copper miners in Chile and Peru are facing massive strikes in aging infrastructure. Even at $76 an ounce, it takes 10 to 15 years to bring a new mine online in the United States due to environmental regulations. We are in a structural trap. Demand is exponential, driven by AI and green tech, while supply is in a terminal decline. This is the definition of a supercycle. The major miners, Hecla Mining, First Majestic, and Kerr Mining, are seeing their operational cost rise, but their margins are expanding even faster. If you want leverage on the silver price, you have to look at these equities. While silver corrected 35%, many of these mining stocks only pulled back 10 to 15%. This is a sign of institutional accumulation. The big funds are buying the miners because they know the dividend payouts in 2026 are going to be historic. Silicon Valley, panic, and the Nvidia connection. While the average American is looking at the price of silver through a coin shop window, Silicon Valley is looking at it through a microscope of survival. In 2026, the AI arms race has entered a new desperate phase. The latest generation of H200 chips and the massive data centers being built by companies like Microsoft and Google have a secret dependency. They require massive amounts of silver for their high-speed interconnects and thermal management systems. Why silver? Because as these AI chips get faster, they generate more heat. Copper can no longer handle the thermal load at these frequencies. Silver is the only element that can move that much electricity while dissipating heat fast enough to prevent a hardware meltdown. We are hearing reports that Nvidia and other tech giants have begun bypass trading. They aren't buying through the COMEX anymore. They are going directly to the miners with private offtake agreements. This is the shadow market. When the world's most valuable companies start hoarding a metal for their own survival, they don't care about the spot price. They care about the delivery price. Because for Silicon Valley, an ounce of silver at $500 is still cheaper than letting $1 billion data center sit idle. The American investor needs to realize that they aren't just competing with other stackers anymore. They are competing with the balance sheets of the trillion-dollar Magnificent Seven. If you wait for the price to look right, the tech giants will have already swallowed the entire available supply. The COMEX default scenario, when the paper market breaks. We have to talk about the elephant in the room. And so, back in May, what happens if the COMEX, the primary exchange for silver in the United States, actually defaults? To understand this, we have to look at the London Metal Exchange crisis of 2022. When the price of nickel went parabolic, the exchange didn't pay out the winners. They simply canceled the trades and closed the market to protect the big banks. In April of 2026, we are seeing the same warning signs in silver. The registered inventory, the silver that is actually available for delivery, has dropped to levels that haven't been seen in over 30 years. Meanwhile, the open interest, the number of paper promises to deliver silver, is at an all-time high. If a major industrial player or a sovereign nation like China demands physical delivery of their entire contract, the exchange will be forced into a force majeure event. In that scenario, the paper price of $76 becomes meaningless. The only price that matters is the price of the metal in your hand. This is why the paper-to-physical ratio is the most dangerous number in finance today. If you hold your wealth in a silver ETF or a paper contract, you are a creditor in a bankrupt system. When the music stops, the chairs will be taken by those who hold the physical bars. The Patriot strategy, surviving the revaluation. So, what is the strategy for the American patriot in this super cycle? It's not about trading anymore. It's about repositioning. The first step is acknowledging that the dollar is in a terminal decline. The second step is understanding the difference between investment silver and survival silver, or every American should have a core position in what we call constitutional silver, the pre-1965 dimes, quarters, and halves. Why? Because if the digital banking system goes down, or if the dollar loses its domestic purchasing power during a hyperinflationary spike, these coins are recognizable, divisible, and legal tender. They are the ultimate insurance policy. For the wealth accumulation phase, you want to look at sovereign minted coins like the Silver Eagle or the Buffalo, but beware the high premiums. If you're looking to maximize your ounce count, silver rounds and bars from reputable private mints are the way to go. The key is physical possession. In a world where China is hoarding and the Middle East is on fire, an IOU from a bank is a liability, not an asset. The correction to $73 was your last warning. The move toward $111 was a preview of the price discovery phase. As we stand here on April 10th, 2026, the window is closing. The supercycle isn't just a market trend. It is the final revaluation of the world's most undervalued asset. Central bank, digital currencies, and the off-grid alternative. As we move deeper into 2026, the Federal Reserve is accelerating its testing of the FedNow system and the digital dollar. Many analysts believe that a controlled collapse of the traditional banking system will be the pretext for forcing every American into a central bank digital currency, or CBDC. In a world of digital money, every transaction is tracked and your spending power can be turned off with a click of a button. Silver is the ultimate off-grid alternative. It is private. It has no counterparty risk. And unlike a digital currency, it cannot be deleted. As the Lebanon conflict threatens to pull the world into a wider digital war, with cyber attacks on banking infrastructure becoming a daily reality, the value of a physical, non-digital asset is skyrocketing. We are seeing a new class of investors entering the silver market, the tech preppers. These are people who work in the software industry and understand exactly how fragile our digital systems are. They aren't buying silver because they like the shine. They are buying it as a failsafe against a systemic reboot. The DXY breakdown, the dollar's last stand. The US dollar index, or DXY, is currently showing a death cross on the monthly chart. This is a technical signal that has preceded every major dollar devaluation in the last 50 years. As the DXY falls, silver rises. It is an inverse correlation that is as old as the Republic. The world is losing faith in the full faith and credit of the United States. With $34 trillion in debt and interest payments now exceeding the defense budget, the math simply doesn't work. The only way out for the Treasury is to devalue the debt by inflating the currency. This is the hidden tax on every American. When you buy silver at $76 today, you aren't just buying a metal. You are shorting the failure of the central banking system. The silver for oil trade, not bypassing the Treasury. We are witnessing the emergence of a new global trade mechanism that bypasses the US Treasury entirely. Reports from the Asian Development Bank on April 9th suggest that several BRICS nations have begun settling oil contracts using physical silver as a settlement medium. This is the silver for oil trade. Historically, oil was only sold for dollars. This was the petrodollar system that gave the US dollar its value. But as the dollar weakens and silver rises, oil-producing nations are looking for hard assets. Iraq and certain Gulf states are reportedly accepting silver bullion at a settlement premium. The This creates a floor for the silver price that is entirely decoupled from the COMEX paper market. If you are an American investor, you need to understand that the global energy for hard assets trade is the ultimate death knell for the dollar's dominance. The U.S. Strategic Reserve Crisis empty vaults. While the average American is aware of the Strategic Petroleum Reserve, SPR, being drained, very few are aware of the U.S. Strategic Silver Reserve, or rather the lack thereof. In 1960, the U.S. Treasury held over 2 billion ounces of silver. Today, that reserve is effectively zero. The U.S. government sold off its last remaining strategic stockpiles in the late 90s and early 2000s to suppress the price and keep the digital revolution cheap. Now, as the Department of Defense realizes that silver is a critical mineral for the Tomahawk and F-35 programs, they are forced to buy back silver at market prices. We are hearing rumors of emergency procurement orders being issued to domestic miners. This means the government will be competing with you, the retail investor, for every available ounce. When the government starts panic buying an asset they used to ignore, you know the top isn't even in sight. The mining equities deep dive, Leversensis vi destorarti, its leverage in the shadows. If you're looking for triple-digit gains, the physical metal is your shield, but the mining stocks are your sword. As of April 10th, the silver-to-gold ratio is still historically high, but the mining-to-silver ratio is even more disconnected. Let's look at the big three for the American portfolio. First, Hecla Mining. As the largest primary silver producer in the U.S., Hecla is the safe harbor. And their Lucky Friday and Greens Creek mines are currently producing at record margins. If silver stays above $75, Hecla's free cash flow will allow them to clear their debt by the end of 2026. Second, First Majestic Silver. CEO Keith Neumeyer has been a vocal critic of the paper manipulation for a decade. First Majestic has begun withholding production, refusing to sell their silver at suppressed paper prices. This is a corporate silver squeeze. They are waiting for the true value to be realized. When they finally release their stockpiles at $150 an ounce, the stock price will likely go parabolic. Third, Wheaton Precious Metals. This is the streaming giant. They don't mine silver, they buy the rights to it at a fixed cost from other mines. Their input cost is locked in at 2022 prices. This means every dollar silver rises above $30 is pure profit. They are the bank of the silver world, and their dividends are expected to triple by Q3 2026. The grid collapse, paradox, the invisible demand. There is a massive demand driver for silver that no one is talking about, the U.S. power grid. As we shift to EVs and AI data centers, our aging electrical infrastructure is screaming for upgrades. High-voltage transformers and circuit breakers require massive amounts of silver for their contact points and conductive paths. According to a report released on April 8th by the Department of Energy, the U.S. needs to replace over 60% of its high-voltage transformers by 2030. Each one of these massive units contains pounds of silver. Because of silver's unique conductive properties, there is no substitute that doesn't significantly increase the risk of a grid-wide fire or failure. The grid rebuild is an invisible, mandatory demand driver that will consume millions of ounces of silver regardless of what the economy does. Even in a recession, the lights have to stay on. The final verdict, April 10th, 2026. We have seen the correction. We have seen the floor at $73 hold firm despite the massive manipulation on Wall Street. The volume on the exchanges is telling a story of deep pocket accumulation. The weak hands have been shaken out. The retail panic of last month has turned into a professional squeeze. Bank of America's updated blue sky forecast of $309 per ounce is no longer looking like an outlier. When you factor in the Samsung solid-state battery, the India import surge, the China export ban, and the Lebanon energy crisis, $300 is a conservative estimate for a market that is fundamentally broken. The path from 111 to 73 wasn't a failure, it was a transfer of wealth. It was the last chance for the American patriot to get positioned before the China vacuum and the Indian rush finally pull the price into the triple digits for good. The supercycle is accelerating. The question you have to ask yourself before the markets close today is, do you want to be the one selling at 73 or the one holding when the dollar finally breaks and silver becomes the only true currency left? The moment history is made is right now. Watch the $76 level. If we close above it this week, The fuse is lit. This has been your daily silver market alert. Stay vigilant. Stay physical. And we will see you on the next update.